Sakib Manzoor is a well-known financial broker in Sydney. A lot of people know it. He was the speaker in our last year Money Matter event as well. Without further ado, I would like to invite him to present Sakib Manzoor.
Assalamu alaikum. Yes. Yeah. Good afternoon, everyone. I know we have been listening to so much information for so long, including myself. As much as there was the great knowledge that we had, I would like everyone just to get up for 5 seconds. Just shrug themselves. Just 5 seconds, please. And I promise I will give you as limited information as I can to make it less painful. I think that will do the job now. Thank you very much.
Thanks, Father.
No worries. So I'm starting off with a second slide from Coach Ahmed. Oh yeah. So I could see something that I could talk about this. I said, okay, maybe that's a better way of me interlinking into then start my own presentation. So he talked about fear of failure, fear of uncertainty, and that is for fixed mindsets, I believe. So you've got to be a growth mindset who is looking to have the change. Personally, I believe there are 2 ways that you can actually move into a changing or progress direction. One is obviously you play with your mind. Work with someone like Coach Ahmed. Get to a point that your mind is so, ready that you are able to take your next step. The other way is where you load yourself with so much information, so much real life examples in the industry, that leaves you with no option but to make your first move. And that is, I believe, where I can help. Now, in this regard, we are talking about property in general. The people have a fear of failure, fear of uncertainty, and they have a limited belief or knowledge. Hence, they don't make a move of either buying the first property or getting into further investments. Just anecdotal examples. Mount Druitt median house price in 2000 was $145,000. Its median price in 2025 is $1 million. Bochum Hill's median price in 2000, 25 years ago, it was $300,000, and in today's market it's $2 million. In Virunga, which is the North Shore line, the median price in 2000 was $875,000, and in today's market after 25 years, it's $3 million. One thing they all have common, they have all increased close to 7 times in the last 25 years. That makes it 3.5 years. Every 3.5 years, the property price doubles up. And that is only a historical figure of last 25 years. If you go further back, if you had a house in Bochum Hills back in 1970, a median house price was $20,000. It's 100 times increase in value in less than 55 years. I don't know, I'm yet to see any other investment, especially in an Australian brick and mortar context, where you can make this much value increase or capital growth other than investing in a property. Now, I wish that everybody had enough money in Australia that they didn't have to borrow or didn't have to ask for money from a third party, be a lender or bank in this case, or other people, and they could just use their own money to buy investment or properties, and they can double up their income every 3.5 years. But unfortunately, that's not the case. So we are left with only one choice. That is, you can come up with your savings as much as you want to. It could be 5%, 10%, 20%, but that's about it. That's the maximum probably you would end up having when you have to do a Monday to Friday 9 to 5 job where you have to feed for your family as well. That means you need a third party intervention who would lend you 70 to 80% of the income. And the only way you can do that is through a system which is called financing. So whenever there's a financing involved, there's a lending involved, there's a mortgage broker involved. So I am a finance advisor. I'm not a financial advisor, but my advice is very specific to financing, predominantly to invest in buying a property. We also call credit advisor. So we advise you in how much credit we can help you borrow, which then you are able to repay in a certain time frame. And it's based on your financial circumstances. So that's the context that I want to start my presentation, which is only 5-6 slides, so I'll finish up within time frame. Can you go to my... So I represent Secure Finance Services, which I founded in 2014. So this is my 11th year, start of the 11th year. So from being a one person as a mortgage broker in 2014, when I settled $20 million, last financial year, which was 10 years, we settled $200 million worth of home loan settlements. So we have increased tenfold in 10 years. We grew from one person to now a team of 10, 11 people based in Sydney, and we've got a team of 3 to 4 overseas staff based in Pakistan as well. So with us, you get a volume. With us, you get a knowledge base. With us, you get an experience of someone who's been doing it for over a decade. I come from a financial services background. I'm an MBA, I'm a Master of Management. I've worked in financial services sector. My last job was with American Express for over 7 years. So I've done it for so many years that I bring that knowledge base with me. Then I've trained so many brokers in my profession who now help me carry the load that we have. So, can you go next please? So I will focus now, I've already given you context of finance. I'll just bring the focus back to just the opportunity year, which is 2025. Just a quick rundown. We had the highest interest rates for last 15 years, starting from 2022 up until just 2 weeks ago, where we had the interest rate going over 6.5%. And that is when the median prices have, as I mentioned they have gone 7 times in the last 25 years. We just had just about started a cash rate cycle where we had our first drop, which was last week, and that was a drop of 0.25 of 1%. And the way it's being forecasted, we are looking for at least 4 to 6 rate drops in next 12 to 18 months. What does that present to us as opportunities? Whenever there's a rate drop, it eases up your borrowing capacity. Your potential to borrow more, your potential to invest more, it increases with every interest rate that drops. So, when the rates drops will start impacting people, you will have a lot more people in the market looking for properties to buy. That means there is going to be a lot more demand in the market. When there is going to be a lot more demand, that is going to also drive up the prices. So the timing, what I believe is now, from now to maybe next 6 months, if you had any property plans to buy your first home or to do investment inside or outside super, probably this is the time. Because there is a big chance if you will start looking for property to buy after 6 to 8 months, once we had another 2 to 3 drops, you might end up paying 5 to 10% more for the same property that you can buy now. Next one, please. Okay, so also, again, this is not a property advice, but it's just generally what being forecasted. The 2 markets that's been lagging behind in Australia for the last 2 or 3 years when the rates were so high, that was Sydney market, it was quite slow, as well as the Melbourne market, whereas the Queensland, WA, South Australia market is already doing really well. Now they're saying with the rate drops, it's going to kickstart Melbourne, Victoria, as well as the Sydney market. So these are the areas where you will see, especially in Melbourne market, anyone who's looking to do a low end of investment property, probably Melbourne is the way to go. That is for someone who is just looking for investment property. They can invest, set and forget for a time being, and then they will review maybe on a yearly basis. Next, please. So borrowing wise, I'll just quickly go through this. There are 2 types of borrowings basically whenever a bank will look at you to see how much you can borrow. Either you are a salaried class where you're working on a TFN. TFN means 9 to 5 job. They will look at how many income earners are in the family. If husband and wife are both earning, it's better. You will have more borrowing capacity. If you have an investment property already and there's a rental income against that property, that adds up to your borrowing. But that's it. There is nothing more that you can add to your income unless you had a second income, someone driving Uber with the Monday to Friday job. Whereas with self-employed, there are a lot more variety. There's a lot more, you say, leeway in terms of what is classed as income for banks to look at when they look at your borrowing capacity. It could be the income that you draw from the business. It could be the family income that you're giving to your wife or other family members. It could be a second job that you're doing along with your business. It would be a gross profit of the business. It could be the depreciation of the business that the business is claiming. It could be any interest that is being earned within that company or business structure. All those are added back, and the total is your income. So more you have of these, the higher your income would be. Yeah, next slide, please. Okay, so now it's, as I mentioned, that if no one has 100% money to invest in a property, you need a financing scheme. It can be done by you going directly to the bank, or you come to brokers. The question is, why would you come to brokers? 74% of home loans in Australia are actually done by brokers. There are 20,000 plus brokers in Australia. Only 26% home loans where actual clients will go directly to the bank. There must be a reason for it. And our share is growing. When I started 10 years ago, less than 50% people were going to brokers. And now 10 years fast forward, almost 3/4 of the people are coming to us. The reason why we do it, we sit down with you, we do a fact find, we check your need analysis, we see what you want now, what you may also want in next 2 years' time, 3 years' time, 5 years' time. Do you have enough money in your self-managed super fund? Is there a way sooner or later you would be able to borrow enough to buy a property inside your self-managed super fund? We have all those discussions with you. We set your goals for short-term, for long-term, and based on that, then we would advise you to how to proceed from that point onwards. Plus, we have options of all the lenders. If you go to CBA, CBA is going to give you what they offer. With the broker, you have option of all the lenders. And there are 40 plus lenders, small, second tier, and even specialist lenders. Banks will only give you what they have, but we can tell you, it actually, if you were doing a normal job where it's a base salary, husband and wife, probably any bank will do the same thing. But if someone is working on, for example, a lower commission, the base rate is very low, but the commissions there is a lot higher, the different banks will treat you differently. If you earn bonus with your base salary, and you got higher bonus in 1 year as opposed to the other one, different lenders will treat you differently. One will take average of 2. One will take the lower of 2 if it's lower in the latest one. One will take only the last 1 year ones. So there are so many different parts of your income, which we call lending policies. We, mortgage brokers, are aware. We know which lender will suit in your special circumstances versus the other one. So that's why you need to sit down, go through your need analysis. We go through your income, and then we will shortlist or recommend you the best 2 or 3, the lenders where you are able to get the best that you're looking for. Next, please. That's fine. We have talked about that. Next, please. That's it. So, again, as I said, we are finance advisors. We are in a business of advising on your finance matters, on your credit matters. We can run through real life examples with you where someone can, with a salary of husband and wife together, $200,000, they can start with one owner-occupied property, and in 3 years' time, they probably will have an investment property outside super fund, and they can have an investment property inside super fund. Add another 3 to 4 years where the earning capacity has gone up as well. Now they probably will have enough portfolio to have 3 to 4 investment properties outside super. And the way, as I mentioned at the start of my presentation, the property prices historically has been doubling up. In 5 years' time, you would have a big chunk already accumulated in equity. In Australia, the hardest part is to buy your first home. Then a home will buy another home. You just need to earn enough to be able to borrow. But the equity part, which is the hardest part, especially for most of us immigrants who move at a later stage of their age, equity is the biggest part of this one. And that's the only for you to accumulate equity by having your first property, try to pay off earlier, and then wait until the price appreciates, come back in the market, we help you buy the investment property from then onwards. Any question? Happy to answer.
Hassan. Hassan has a lot of questions today.
I'm surprised you're still giving me the mic, so I haven't reached my quota. Thanks for that presentation, it was very enlightening. If you're looking to refinance, what would be the main, and I'm talking in Islamic finance context, if you could limit at that, what would be the main considerations when you're comparing lenders? Obviously, interest rate being one, you mentioned, not everybody will give you, if you have a business, for example. What are some of the main considerations, would you say?
So one of the biggest one is a cost, for sure. Considering the Islamic lenders are less cost effective when you compare them with the conventional banks. So a lot of people, they start with good intentions, from my experience I can tell you. But a year, 2 years into it, then the gap of the repayments in Islamic lender versus the conventional is a lot higher. So sometimes they would want us to move them to the conventional lenders. So that could be one. So obviously they look for the lowest rate possible. Even within Islamic lenders, that's the foremost reason people will go, because the rates are different from one another. The only problem is we don't have too many Islamic lenders, so that's why the choice is limited. The other biggest reason people will do that is the equity release. So once the property prices have appreciated, you have paid up a big chunk of your loan, and now they want to invest into a property or a business or SMSF, so be it. Then they will see which Islamic lender will facilitate that better than the other. And I'll give you an example. I had a lender who had a first owner-occupied loan with MCCA, and he got a pre-approval from them to buy another investment property. And once they put down the deposit for the property, they said that now to go for a full approval, unconditional approval, they will have to do a physical valuation of not just the new property, but for the existing property as well. So in that case, when they actually sent someone to do a physical valuation, they found out they had some structural damage at the basement of the house. And they said that until you fix this, which probably would have cost them more than $50,000, we would not accept the security, we would not accept the value from it. So the whole deal was falling apart at that stage. So then that person comes to me, and then we do a valuation with Ijara, for example, and I knew that for the existing property, they would do an online valuation. And the valuation wasn't an issue. It was the issue that we didn't want someone physical to go there actually to do it. And this way we were able to move them from MCCA to Ijara, and also be able to settle the new loan the way they wanted. So all these different reasons. The best part is, come to us. We don't force you to refinance unless there is a reason for it. Because we also have a policy, regulation is called BID, best interest duty, where if we can only do something if it's in the best interest of the client. So even if that involves us moving you from one bank to another bank 3 months after getting you a loan, where we get a clawback of that commission because you work for commissions, we still have to do it. Because that's in the best interest of the client. So that's what we would do. You come to us, discuss the situation, and we will suggest you whatever is best in your interest, and then you make the decision. Thank you.
Anyone? Any last question for Sakib? Okay.
Yes.
How about in getting finance for property within self-finance group?
Yes, thank you. I forgot to mention that bit. Thanks for mentioning it. Now, this is one of the most popular loans that we are doing now as compared to 5 years ago. So 5 years we will probably do 1 out of 20, it'll be an SMSF loan. Now it's like 2 out of every 10. And the reason is, first is obviously the knowledge base. A lot of people understand how it works. Plus some rules change where they allowed 6 people as opposed to 4 people. So now it's a bigger leverage, a bigger pool of the money people are doing together. So that kind of gives them a leverage that, okay, decide, pull the money together. Now inside self-managed super fund, the borrowing works differently. There are only 2 factors that would decide how much you can borrow inside the self-managed super fund. One is your contributions that you receive either from your employer as well as the personal contribution that you are making. And they generally look at the average of last 2 years. Plus the proposed rental income from the property that you're looking to buy. How much you earn doesn't make any difference. What other assets and liabilities you have, they will ask for it, but they won't factor them into seeing how much you can borrow. So as long as the contributions are and the rentals are enough for you to borrow the next property, they will let you. That is why it allows us mortgage brokers a bit of a leverage or a flexibility where you are getting close to the borrowing but you're just not there. We would say, okay, would you like to talk to maybe your accountant or financial advisor? Maybe do some personal contribution. So by doing that extra personal contribution, then they are able to meet or whatever minimum income of the super fund that they need to meet to be able to borrow. The other side, I believe all the accountants have mentioned is the capital gain within SMSF is a lot more attractive than outside. I think there's a cap of 10% if you sell it before you retire, as opposed to could be a 47% in your bracket. And after you sell it after you have retired, then it's a zero tax capital gain. The properties inside self-managed super fund, in most cases, sooner or later are positively gained. It's not negatively gained. That's how they work better because the rate is fixed 15% there. So that's why there's no benefit.
So just to confirm, does that mean you can't actually use it within the first 2 years?
Uses and in?
As in, if you just started at SMFF, you can't actually borrow within it for the first 2 years. Is that what you're saying?
No. You can borrow whenever.
Oh, okay.
Borrowing has got to do with how much. Sorry, I get your question. So no, they won't see SMS. SMS you can actually set up after, and I can get you a pre-approval before for it. So they just need to see self-managed super contribution coming in anyway. It could be your existing super funds as well. So they just got to see to your consistency that, because at the end of the day, if they approve you the loan, they got to make sure that loan gets repaid. So one way is the rental income, which is never enough. And the second is the extra contribution coming from employer as well as yourself. So you can do that. All good? Thank you very much.
Sir, my last question. Can you buy land as an investment property or there won't be any income generated?
Sorry, inside super or outside?
Inside super.
Inside super, you can, my understanding is you can definitely buy as an investment, or you cannot borrow on the land. For a lender to lend you money, it has to be an asset which generates income. So land doesn't do it. So there could be a question for maybe you can ask accountants later on as well, that if you have enough money to buy land, and then you add more superannuation money to build on it, then is there a way that we can actually, because now it's an income producing asset, is there a way that it would allow us to actually borrow that money and take it out? But if it's just a standalone the land that you are looking to buy, we can't borrow against that inside. Thank you very much.
Thank you.
Sakib, really appreciate.